All right, hello everyone. Welcome to this next panel on funds versus vaults, asset management meets asset curation. I'm Ralph, the head of BD for Nexus Mutual. Joined up on stage, delighted to say I'm joined up on stage by these four gentlemen. We've got a real sort of strength and in depth and breadth across the DeFi industry here. We've got a vault and lending protocol platform. We have oracles covered, the vault curators themselves, and also Laszlo here, building a validator business that has a full stack yield experience. And I believe you made an announcement earlier today, so maybe you'll touch on that in a moment. With the rapid growth that we've seen in Vault TVL, for Nexus Mutual, from my perspective, we see vaults as a really key pillar and strategy for 2026. And of course, like with the events that have occurred over the past few weeks, I think this is a very timely discussion, given what happened with Stream Finance. And I had a lot of people asking me about it, so hopefully we'll get into a little bit of that here too. With that said, I'd welcome everyone just to give a very quick, short introduction, if we maybe start down that side.
All right, so I'm Merlin, co-founder of Morpho. We are building a universal lending protocol. There's close to 13 billion of total deposits across many different networks. And we have fintechs, centralized exchanges such as Coinbase, large asset managers that are building earn, borrow product, curation product on top of Morpho. And obviously are using vaults a lot.
Yeah, hello everyone, I'm Dillon. I'm leading the business development team at Dia. Dia is a cross-chain oracle, currently supporting 61 different blockchain networks, really specializing in lending and borrowing markets. So the vault curation side is super interesting for us as well. One high level, Dia was founded in 2018. The product's been live in production since 2020. So actually one of the older oracles in the space, and happy to be here.
Cool. Hey, everyone. I'm Jacob, head of structured yield at Gauntlet. Gauntlet is the largest risk creator in the space. We started at 0 TVL in the beginning of 2024. We're now at 2 billion. I manage a team of quants that runs DeFi strategies across multiple chains, different protocols, using our in-house incubated vault infrastructure called Era.
Hi everyone, I'm Laszlo Zebo, the co-founder and CEO of Kiln. So Kiln, we are the leading on-chain yield platform for institutions and wealth. It means that we have started with staking, offering staking for wallet custodians, exchanges, asset managers. We've grown into $8 billion staked of assets this year, and on the staking side of things, and then we're now offering lending. Since a year and a half, we've grown to $400 million TVL with some of our partners here. And we've announced essentially today our own on-chain asset management protocol called Railnet. So very happy to be here. Vaults is everything we do these days.
Cool, thank you guys. Okay, let's start with you, Merlin. Morpho's really catalyzed the role of vaults in DeFi. Could you please set the stage for us and reflect on just the state of vault curation? Perhaps, given the title, where are we at in terms of on-chain structures rivaling traditional funds?
Right. So I think 2 years ago, the term curation was not created at all. I think we coined it when a little bit after Morpho V1 was deployed. Where we had risk managers, risk curators that were building on top of Morpho, and we came up with that term that was kind of categorizing those new kind of partner or this kind of new business lines where you have a risk manager that is allocating liquidity in a non-custodial fashion for end users and depositors into that vaults. So we started 18 months ago. Now there's 300 maybe vaults on top of Morpho. Gauntlet has, for instance, like 2 billions. I think on Morpho there's like almost 10 billions of assets under curation, something like that. It opens a completely new business, and it also the capacity to create end-to-end earn product that are fully owned by the entities that are building those products, those years product. So they can select the risk exposure for their users. They can select the risk, the configuration of the vault, who is owning it, who is managing it, and it unlocks a lot new capacities and flexibility for what can be built. And I think it will expand a lot what currently is DeFi, which is more centered on a centralized and one-size-fits-all model that other lending venues are presenting to users. And that is great from a UX perspective, but is not scalable in a world where millions of assets will be tokenized and 8 billion users will come on-chain at some point.
Thank you. Let's jump to Jacob. So if I were to ask a normie what they thought a vault curator was, they might come up with some strange response around, I don't know, museum archivist or archaeologist. And I sometimes quip that hedge fund managers are they've rebranded themselves as vault curators. Is this a fad or is this here to stay? Can you explain from Gauntlet's perspective, how does it view itself between being an asset manager, vault curator? Like, what's the line there?
It's a great question. Great question. One that we get all the time. Let me answer the latter question first. Is Gauntlet an asset manager or a curator? We are definitely a curator. We are not an asset manager. Our definition of curation and asset manager is very, very different. I think to answer the question, you kind of start with like the levels of trust required for an asset manager and the level of trust for a curator. Asset curation has really lowered the barrier of trust required to put your money where you want to invest. And that's done only by smart contracts, right? So like previously, before smart contracts, there's no way to like basically have someone manage your money without actually giving it to them. But smart contracts basically enable you
to have like a universe constrained set of actions that you can kind of take that is one verifiable on chain and is enforced programmatically. And so like, for example, in asset management, what are you trusting? Basically, you're trusting the brand. In Curation, you're trusting brand as well. But you're also trusting the legal infrastructure around it. You're trusting the fund perspective after doing research. You're trusting the reporting is honest. Whereas Curation, this idea that code is law, is on-chain and fully verifiable. And so the lowering of trust really just allows us to actually more efficiently manage funds within a constrained universe of actions that are all on-chain. So I think that's the beauty of it. Like, for example, another huge benefit of asset curation is like you lower the minimums that are required, right? Like asset management is actually only accessible to like very, very high net worth individuals with certain credentials. Asset curation anywhere in the world is permissionless to enter. And so I think, I think at Gauntlet, we do view ourselves as asset curation. And one thing that I want to call out is that you're going to hear this word a lot today in this panel is that's non-custodial, right? Non-custodial is everything. We cannot move your money out of this vault. It would be impossible for us to do it. And so I think that removal of the requirement of trust really, to me, I think asset curation is the natural evolution of asset management. And it's not a fad. It's going to be around. It's another option that's going to be around for many, many years.
I certainly agree there. Just wanted to double check. So, Dillon, I imagine that until Black Friday DPEG, as we termed it at Nexus Mutual, like the events on 10/10, might have actually been that a lot of people weren't as aware of like the vital role that oracles are playing in the space. Could you start by explaining the difference between fixed rate and market-based oracles, and then go on to share how DIA interfaces with vault curators?
Yeah, absolutely. So, oracles have always been on this, kind of like the back end of DeFi. It's not really like a retail-facing component that people are very educated about, especially when you talk about the risks associated with oracles. The difference, to get directly into the question, the difference between a hard-coded or a hard-pegged price feed versus a market-based price feed is pretty simple. A hard-pegged price feed, and we typically refer to these in terms of like pricing stable coins, right? So a hard peg would be pricing it at $1 without any variance. You're not taking into any account market rates or fundamental net asset values to actually change the value of that price feed. It's pegged to one. Whereas a market-based or a market rate feed actually takes real trades across different markets to generate the price feed of a given asset. And so, at a high level glance, like a hard pegged asset might seem to smooth volatility for a given pool or for a given market. And it works well until it doesn't. And I think that's what the events of the last couple of weeks in any black swan events in the industry show us. Like, things tend to work well until they don't. And then you have these cascading effects of liquidations and other things that are going wrong. And so the hard-coded oracle in our outlook is always something that works when the industry is fine, and something that really is a huge risk when things start to fall apart. And it can leave the protocol with bad debt. Liquidation mechanisms don't work as they should because the oracle is pricing it at $1 when really the stablecoin depegged and is trending towards zero. So that's the core difference. And one thing I just want to add that I think is interesting on this topic is I hinted at it earlier, is not just now a difference between hard pegging and market rate, but also the introduction and the more common utilization of fundamental rates, so net asset value backed price feeds. So you might see that like CDPs or stablecoins or other assets have, let's say $500,000 of liquidity or $1 million of liquidity on a DEX or across the markets. That's not a very robust amount of liquidity to create a resilient price feed. And so now, within the scope of how DIA is working with curators, we're seeing more interest and demand across the industry for these net asset value-backed price feeds. So you're not just doing a market rate feed, but you're also looking at assets that have, let's say, millions, if not tens of millions of collateral that are collateralizing these assets in reserves that are either held on-chain or off-chain. And you can create pretty resilient price feeds by using that collateral as kind of like a proof of, a proof of collateral. Or proof of reserves, as it's historically known. So these are the different ways. And then the last thing, sorry, it's a long-winded answer here, but I think customization is extremely important. When we're speaking with curators, it's a matter of customization. Obviously, quality is always the most important, right? Quality and performance over time. But then also flexibility, customization, and the ability to be extremely transparent in how an oracle is coming together so they can actually manage risk adequately.
Thank you. Laszlo, from my time being in the staking validator game, Kiln is very well known for its enterprise-grade validation. But from ongoing conversations, I know that Kiln's roadmap is all about helping its customers unlock all forms of on-chain yield. This ties back to the announcement that you made again, I think, but given that you count many funds and asset managers already as clients, and then you're increasingly working within the Vault Curation space, could you share what key similarities and differences you see between those different actors?
Right. I think the asset managers in the space started with ETF product, right? If you take BlackRock, it was a very good example of a successful off-chain product that has been massively adopted. But then they kind of realized a lot of these rails could be put on-chain because they will reduce cost and essentially tap into a new type of user base that they wouldn't have access to prior. And even these users wouldn't have access to this product prior. So I think, tokenization or real-world asset, as you call them, of money market fund, private credit fund, is the kind of the second step for them to tap into crypto after the ETF. But you will see more and more these guys running on-chain funds or vaults or on-chain asset management. We can definitely talk about it, but I guess I could potentially disagree with the curation and on-chain asset management part, because I think just the fact to have the word on-chain would mean non-custodial, would mean that the NAV and the risk is calculated in real time on-chain versus an opaque type of reporting off-chain or redemption requirements that sometimes you don't have with an on-chain asset management product. So I'm pretty sure, certain, we have a lot of these discussions that you will see these asset managers running vaults or running on-chain funds, if you will, after the crypto ETF and the tokenized assets that they have launched prior. And the last part is, this is why we built Railnet, and we announced it today. Railnet is this idea that we need a new standard of vaults to wrap synchronous, right? So what is lending today? For example, you can have redemption time instantly on chain with asynchronous flows. What's going to come more and more into DeFi, real-world assets, or asynchronous DeFi protocols, and all of that, so that you can tap it into a vault with instant redemption, which you don't have with off-chain asset management.
Cool, thank you. Let's discuss a little bit about some of the recent market turmoil. I had several fund clients come to me and ask if I would provide underwriting coverage for Stream Finance, and I shared the request with my head of risk and product. They came back to me and said, this is a hot ball of risk, we're not going to touch it, okay? Like others, my motto in 2022 was, if you can't understand where the yield is coming from, you are the yield. With echoes of like the C DeFi space, Celsius, what are the key lessons this time around? Is it same, or is there anything materially, markedly different? And that's open to all the panelists here. Who would like to take that first?
I can. I guess the clear advantage is we're building on top of public blockchain. So all the information is here. Everything is public. I think Jacob was mentioning that you have real-time reports at any time. The real question is, how do we surface that to the end users, or at least the one that take the decision to deposit into a specific vault? And that's the key element that we need to solve as a provider of infrastructure. One huge topic that we're working on at Morpho is partnering with, for instance, Credora to display risk rating. That's one that is powered by Redstone. That's one way to surface what risk end users will take when depositing into a vault. Obviously, risk is multidimensional, so trying to condense that into one layer or several is quite it's reductionist, and it can't provide all the information, but that's one way. We're going to work a lot on surfacing over information about the Oracle, what's underneath at the market level, etc., and maybe move more toward a prosumer approach of product rather than the consumer one. And on top of Morpho, because everything is at the smart contract level, you can still builders, distributors can still create really nice UX with one given vault that is very simple. When they will target a specific risk profile, they won't allow a choice to their users, but it will be an opinionated product. But in this case, the distributor is understanding what the risk of the underlying vault to which they will expose their users to. On our side, we have more infrastructure approach, so we'll continue displaying all the vaults, all the markets, but surfacing all that data.
Yeah, I think Stream Finance is a very interesting use case because I think they advertised almost as a vault product themselves. Like, obviously, we're talking about Morpho vaults. We're talking about like Stream Finance. When you're talking about asset management meets asset curation, I agree with you, Laszlo, on the whole semantics thing. We agree on non-custodial, instant redemptions, all of that. I guess the term, just for the lack of a better term, like Stream Finance was more the traditional asset management. There was no visibility, which is why, talking about proof of reserves and proof of cloud, that's very, very important. There was no visibility. In fact, the fact that like crypto Twitter was talking about for days, like who was it? Who lost the money? No one knew. In fact, I think it was a fund that I personally have never even heard of, and that itself is the problem. And it's important to like distinguish like these types of vault tokenized hedge fund products versus, maybe like a Morpho vault, which has its one mandated use case for what it's built. So I do think that we are going through the cycles of making these types of mistakes, and unfortunately there is always damage done along the way. But I do think that like from BlockFi and Celsius, which that was CDeFi and was completely not transparent and more retail facing, I think that we have made some steps forward, because I think the bar for reporting and the bar for and that demand for transparency is starting to kick in, and I think hopefully we're learning our lesson.
And you have shorter time lapse between you understand, a curator or a non-chain asset manager as essentially used a bad collateral or a good one versus what happened with BlockFi and FTX and all of these dominoes effects. I would say one thing that's going to be more and more important as it is on chain, as you can have real-time reporting, sometimes it's still opaque because you have off-chain mechanism and distribution of these assets. Something that will be key is rating. And how do you rate these vaults, these on-chain funds in real time? And I think today, I think Merlin mentioned Credora is one of the only rating vault mechanism in the market, but you will see more of the traditional financial raters and data providers starting to rate vaults in the future because they really understand, even if they're slow, that this is how their market is going to be evolving. And I think understanding what's the underlying, understanding the on-chain asset manager or curators that you're choosing, right? If it's digital native that have been here maybe for 2020 or 2021 versus a curator or an asset manager you haven't heard and is running a vault for the past 6 to 8 months and have a small team, and then she sometimes take unnecessary risk because they have bilateral deals with these kind of on-chain hedge funds, if you will, which they call stablecoin, and also having these traditional financial asset managers coming into the space that have been creating risk off-chain for years that won't take unnecessary risk is necessary for the space to grow and for what happened with stream finance to not happen again.
Dillon, did you want to say something? Because I saw you pick up your mic before last.
Yeah, I think it was summarized extremely well. I think the overarching lessons, and again, as was mentioned, it's like each time something like this happens in crypto, there are lessons that come out of it. These are steps back in order to take steps forward. With the whole CFI thing, we realized it was a lack of transparency. But now I think that the latest events suggest a lack of transparency more down the DeFi risk stack than what was exposed previously. Like, we're now talking about risk ratings for different assets, but also we're talking about the actual risk associated with a given Oracle provider or the specific part of the DeFi stack, the RPC provider or the bridge provider of the underlying assets. So I think it is exciting, and I think that this is a really interesting stage of speakers because I really like this, where we might be heading towards ideas of risk ratings with Oracle providers and somehow the blend of how the increased role that insurance providers now play within this market as a result of the unfolding of the last couple of weeks. So I'm really interested to see whether these things are going to become more bundled within the offerings or whether they should remain distinct so that there can be third-party,
more so agnostic overviews of the risk associated with a specific provider. Should it be the Oracle that's providing the risk rating on itself, or should it be a third-party agnostic provider? So curious if we see more bundling of these things or a more unique kind of third-party, analysis of the different providers in the space.
Let's switch tack to look at incentives. Back in my TradFi hedge fund sales role at JP Morgan days, you'd often find you get a traditional hedge fund structure is you just quote it as a 2 and 20, a 2% management fee regardless of performance, 20% fee on good performance. There'd obviously be many other potential other pieces put in there, things like a high water mark where
the fund needs to get back above that before it could start earning fees again. And oftentimes, early fund managers would need to put some skin in the game to have investors feel confident to back them. Could the panel explain how this works in Vault Curation? Do they think incentives are aligned and transparent between Vault Curator and depositor? Maybe start with you, Jacob.
Yeah, that's a great question. So Morpho V1 has the performance fee calculated on-chain. Morpho V2 allows two options, a performance fee and a management fee that is just flat on the TVL. For the in-house vault infrastructure that we use at Gauntlet called Era, we also have smart contracts fully on-chain that have logic to calculate either or both an AUM fee, which is the management fee, and the 20%, which is the performance fee. So I think one, that's already a huge step in improvement. There is transparency with fees. We can't embezzle the money, right? Like you can verify it on chain. And then I think in terms of like whether that's the right pricing model, I mean, as a risk creator, it's obviously honestly great if the fees are high, but I have to kind of be honest. I think 2% management fee is going to be a little bit too high for vaults, because if you think about what vaults are, they are more efficient, they are more transparent, and so strategies are going to be more public. But also, a lot of the hedge funds have this 2% AUM fee because of the high operational costs, the regulatory fees that they have to kind of go through, and the operations of kind of maintaining literally off-chain NAV, which is now done on on-chain NAV is you don't need to do it, put anyone on it, right? And so I think just the market will just move towards down from 2, maybe 1. I think it really depends. And then I think the performance fee, in terms of like aligned incentives, I think I'm a big performance fee guy. I think that's the way that we should kind of charge these vaults, just because it keeps the incentive aligned to do a good job as a risk curator and to make sure you're seeking the highest risk-adjusted returns. However, there is obviously a caveat here with that. Obviously, you don't want to completely incentivize risk managers to go crazy and go risk on where they lose the money. And again, we've seen that. But that's where vaults come in, right? Like vaults have clear mandates that are verified on chain, right? Like there's not going to be any surprises of like, wait, why did my money automatically go onto this random L2 that I've never heard of, right? And so I think that performance fees are good, but they're kind of like curbed by guardrails, which I think is really good. So yeah, that's my answer.
Yeah, if I can just jump on, I agree with performance fees, right? You definitely want to have the best on-chain asset manager, curator, to build the best, risk yield adjusted product for users, and then get to the best performance versus their competitors. But the problem of that is, as you mentioned, if you seek for very, very high yields without looking at the risk, and stream finance is a bit that, right? Like it's a one-on-one deal with a protocol where the due diligence was not done to seek higher yields than some of the competitors, the rest of the market. I think one way to fix that is to have these one-on-one deals with these protocols kind of public, right? Kind of on-chain, so that you see if Gauntlet, for example, is making a deal with this new on-chain hedge fund, or that you applied strong, deep due diligence on, at least the market, the user can see that you have done this deal, it's increased the yield, and potentially they, of course, benefit from these increased yields. And that's why, by the way, we've built this protocol, because we think these one-on-one deals should be happening on-chain, so that the end user, while benefiting from the best product with performance fees, still see what's happening in the background.
Merlin?
Yeah, I think, Jacob, you mentioned the management fee. I expect actual creators to use more the management fee for low-risk protocols, low-risk profiles. The reason why is because you can't really take a huge performance fee because the rates will be way smaller. There will be maybe intense competition on those, but at the same time, you still have you still need to reallocate liquidity if something the market conditions change, etc. So it makes sense to have a small management fee on top of that, and take perhaps not much on the performance fee, so that it stays competitive, and users are still willing to deposit even in a low risk strategy.
And maybe just again in reflection of the last couple of weeks, it's like those risk curators or those vault curators, which were adequately managing their risk, actually shown like they shined bright over the events of the last 2 weeks. And I think this is a very open, aggressive, like kind of industry naturally, where there's always going to be a lot of like intense competition, but those managing risk adequately are going to be the ones who actually like are able to secure a lot of the capital and attract more of these capital and depositors over the long term. But I do think it is a really interesting study of like, does it become a race towards zero in terms of like some of the fees? And then to what degree does that make you have to take on more risk to outperform others? But then again, once it's all good until things go south, and then those which actually have been managing risk adequately shine and become the more proven players in the space.
Cool. I think all the panelists have touched on this topic already a couple of times, but thought we should drill down a little bit more here on transparency. Merlin, I think you posted an update on X just a few days ago, flagging the transparency initiatives at Morpho. You're explaining everything on-chain is public, but that doesn't necessarily mean that it's easy to interpret it. Could the panel go into some more detail on which areas in vault curation they think needs more light shone on them, and where does DeFi need to improve to help inform the average vault depositor?
Right. So, as I said, we're working on a lot on how do we surface what's underneath, what are users exposed to. So obviously we're already like showing users what's the allocation of the vault, the different markets, etc. But not necessarily a lot of on the Oracle side, where there's a lot to say, and each Oracle has a specific setup, a specific configuration. That could be the case also for the collateral assets. Also, the curator might have, I don't know, some insurance for users on the side. All those information, we'll try to gather them and at some point surface them into the interface. The risk ratings that we discussed earlier is a great way to condense this information in just one letter, one digit, which for the less savvy users would be maybe the best way. And we could first it would be Credora, but Laszlo mentioned that other risk rating agency that are like, I don't know, S&P, Moody's, they are all coming on chain. They are all looking at what's happening. They understand the game, but now they need to like apply their models, their risk assessment on something that can be updated real time at every block. So it's much more dynamic than what they're used to. So they need to update the game. They need to bring that expertise, but also adapt it to what's this new technology that is way faster. So there's a huge work on our side to survey that into the interface. Also, we've built like June dashboard on all those data that we can that are all public to understand the liquidation, what has been the bad debt of the recent event, what's the liquidation delay on those markets, what's the AUM for each curator. All those information are important one for users, but also distributors, fintechs to make a decision and select which vault, which curator they want to work with and partner with.
Yeah, I agree with these points so much. Like you can have all of these, all of these different metrics that you expose and all these different dashboards, but it's really only the advanced investor that will be able to pair that all together and come to a comprehensive picture of the risk. But I really do like this idea that Merlin's referring to of bringing this all together under one rating. And I'd love to ask, if you don't mind, like, how do you envision this evolving from the Morpho side? Like, you mentioned Credora on the rating side, and maybe for the average investor being able to come to one simple point that, includes all of these different risk metrics. Do you see that as like something expansive, or like in terms of how many different rating providers will be supported on Morpho? How do you see this kind of like evolving?
So I think it's creators will have an incentive to pay for that service at some point, because it will help also them close deals that will bring them like a lot of deposit. So I don't know, if I'm Gauntlet and I have like a plus vault, then I can go to whatever fintech exists in the world and say, hey, we have an A plus vault and you can deposit into that. And on our side, we'll surface that into the interface, maybe because it allows users or integrators to see that and have like a third party that they trust, that is neutral, that is non-opinionated, and where they can see that information. It will be a bit cumbersome for retail users, but this information will inform fintechs distributor that will be the face of those users that don't want to care about what's a vault, what's Morpho, the same way that a user like that is using Revolut, they don't know about what's on the back end.
To add to that, you guys mentioned a lot of things. One thing on the UI is very important. I'm big on showing historical APY over target APYs. I think it's very easy to hardcode target APYs into UIs. I think just full transparency, if every single position of the vault needs to be shown on the page. For one of our vaults called GTUSDA, which is a yield aggregator, we literally show the debt accruing. If there's a leverage position, we show the negative balance there. We even show it when it's in the middle of a bridge, even if it's for a moment. And so just full transparency of what positions the vault is in and making sure that the TVL and the APY numbers are honest.
Yeah, I think again, having great financial rating agencies, there's Credora today, but you might trust S&P and Moody's a little bit more in the future, so that they rate these vaults. And I don't think you will see on these front ends thousands of rating agencies, right? Like, there definitely will be a
consolidation, a concentration of one on-chain asset manager / curator using one of them, because you trust S&P. They have been rating financial assets for years, and they have been the valid chief of trust to do so. I think the other part of this, as we mentioned, more transparency on the Oracle flow, more transparency on the rejection flow of real-world assets, right? Like, all these real-world assets have different period, different compliance mechanisms off-chain, and it needs to be tokenized and shown transparently on-chain, and potentially creates more liquidity on it. That's why we launched our own status. But yeah, the transparency on all the DAX, Oracle, redemption flows, and having better rating agencies in the future, the ones that you see in TradFi and will build into DeFi, is key for transparency, trusting.
Great. And we're really nearly up on time now. So just a final quick fire round. Just a couple of thoughts from each one of you on what you're most looking forward to in the alt curation space of 2026.
Right. We think that vaults are the future of asset management, and everything is coming on chain. It's not if, it's more when, and large asset managers are coming. Let's go.
Personally, I do not. I'm really interested to see what types of real-world assets become most commonly demanded, and how the Oracle is pricing these. So that's the unlock that I think is recasting for us. Like, I think we as an industry are finally heading towards 24/7 equities pricing, because, or rather tokenized equities pricing, because these are now trading on plus exchanges. But seeing how these real-world assets are being used within Vault strategy creation is really interesting. And then also go back again to the Nexus spiritual idea. I'm really fascinated in the underlying insurance that's not going to probably be more demanded within these Vault.
Appreciate the product that are.
Yeah, my prediction is similar. I think
vaults are going to go mainstream way quickly than we expect. If you guys are here at this crypto event, that means you're the crypto person in your social circles, which means this holiday season, your family's going to ask you, hey, which coin do I buy? Or which coin should I buy? Next year, my big prediction is your aunt is going to ask you, which vault should I deposit into?
Right. Yeah, I mean, I agree with all of that. Capital market moving on chain. Traditional asset manager will start to run on-chain funds and offer vaults and on-chain asset management products. And I think you will start to see more of the real world assets into his vaults, basket of stocks, basket of commodities, and all of that mixed with DeFi protocols that quite exciting. So it's good.
Great, thanks everyone.